Let's do Ask Annex. Here we go. Matt Morzy, Director of Research, Annex Wealth Management. Welcome.
Hey, Danny.
Did I get that right?
You did. Thank you.
Congratulations. Good
Thank you,
title.
sir.
Yeah. Let me tell you, that Annex Wealth Management investment team is stacked and packed, and you are a great part of it.
Thank you very
So
much.
Fred Coleman, CFP and Wealth Manager, is here. Hey, Fred.
Hey, Danny.
Question number one. We'll be taking RMDs next year. I don't hear of many taking monthly distributions. Is there a reason?
Everyone is different. When it comes to monthly distributions, some people do decide to take it that way. That's really like if you want your income to come every month. So at the beginning of each year, your RMD amount is determined. Now, that can change each year. So if you do it monthly, then what it is this year can be different next year. So a lot of people may not like that. Also, by doing it that way, it does take away a little bit of the flexibility that you have when it comes to qualified charitable distributions, other tax planning opportunities that you may have throughout the year. Lastly, when you wait the entire year, that does give you the ability to get a little bit more growth sometimes. Now, the market can go down, but a lot of people like to wait towards the end of the year to give the market time to get some growth. Also, get some income off of your investments and just take it in one big lump sum.
Yeah, and I'd say from an investment perspective, that part's important there because, some people worry about the timing of taking that one large distribution throughout the year. And if, we have a bad year like 2022 where the market sold off both on equities and fixed income all year, you're taking a big chunk at potentially maybe the low or the worst part of the year. So some people do like to spread it out just to maybe calm them down a little bit about, are they taking it out at the right time or is this the wrong time to take it? The only other thing I would say, and this is generally going to be pretty minor because at least here at Annex, we're very, very cognizant of this, is transaction fees. If you take it out throughout the year, there's a little bit more trading that we have to do to be able to do that. But knowing that from our side, we're very sensitive about that. We know that fees that go towards, mutual fund purchases or sales are going to detract from the overall value and performance. So we're really thoughtful, but some people don't like it because of that. So there's ways that we can work around that, but a lot of times, for people, it's more psychological than anything else. But I do know that we've had a client in the past that they got paid weekly when they worked. And so when they retired, they wanted us to send money out to them every single week because they were so used to that pattern. And it was just like their paycheck that they're going to have after they retired. So they wanted it out weekly.
Nice. Ask Annex. Next question. I'd like to retire next year, but it seems that's when a recession would happen. Bad idea. And first off, it's his question, not ours. We're not saying that it might not happen or happen next year.
Yeah, and I actually, want to push back on that just from a standpoint of, do you know that we're going to have a recession next year? And if so, what's the market going to do? Traditionally markets sell off and bottom before the recession actually even happens, especially before it's actually called, because recessions are called at hindsight. There's a specific board that goes out and they're the official arbiters of when we had in a recession. And they're going to do it generally after we've already recovered. And they're going to say, hey, guys, remember last year when stuff seemed like it was pretty bad? Well, it was. And so, at that point, they're looking back, you're looking forward. It's really hard to time those things. This is why I think financial planning and the stuff that you do and our financial planning team does, Fred, is really important in terms of trying to plan those things out. But even just going back from the investment side for a second, what is important to me is, what does your asset allocation look like? And then how are you planning these types of things? Do you have a certain amount of money in the bank? Do you have a certain amount of money in savings? Do you have short-term bonds in the portfolio that can weather some of those distributions that you might need early and have enough of that buffer to allow, if we do have a market pullback, time for the equities to recover and have that growth portion of your portfolio, help fund distributions later on in life?
Yeah, and we structure things for retirees based on their cash needs, right?
Absolutely, absolutely. And one of the big things also that's overlooked is when you first retire, having a nice amount of cash put to the side. So if you do face that risk, it's called sequence of return risk, right? And if you have a really bad recession or a really bad market downturn at the beginning of your retirement, that could detrimentally affect your portfolio long term. So sometimes it's really important to have a load of cash depending on the other assets that you have. The other thing that's very important is stress testing your plan. So we can look at your portfolio and say, okay, what if 2008 happened again, 2008, 2009? What if that happened? What would that do to your portfolio? What if last year happened, 2022, where bonds went down tremendously? How does that affect your portfolio? And run all those different scenarios 1,000 different times to see, are you okay? Are you not okay? And that's the big thing. You can't control what the market does, but you can test your plan to make sure that it can live up to whatever happens.
And that's why we do the plan. That's right. All right. Fred Coleman, CFP, Wealth Manager, Annex Wealth Management. Thank you.
Thank you.
Matt Morzy, Director of Research at Annex Wealth Management. Thank you.
Thank you.